I would say even for professional investors, doing nothing is surprisingly often the right strategy.
Welcome back to another episode of WSJ's Take on the Week. I'm Telis Demos.
And I'm Gunjan Banerji.
This week, we're dedicating our entire episode to our guest interview. Our guest is Cliff Asness. He is the co-founder and chief investment officer of AQR Capital Management, and he is one of the world's foremost quant investors and has done as much as anybody to bring those ideas and products to the world. So, Cliff, welcome to the show.
Well, thank you for having me. That's a wonderful start.
Cliff, I'm really excited for this conversation. I was telling you before, I've been following the options market here at the Journal since I've been at the Journal for around 8 years. And, back when I started, it felt like no one was reading my stories. No one cared about this corner of the market. And what we've seen the past few years is options trading is cool on Robinhood. And there's been this surge in options-based ETFs, things like buffer ETFs or hedged equity ETFs. And there are $60 billion in hedged equity funds tracked by Morningstar today. It was half that just a few years ago.
I mean, the Morningstar category, I think you wrote the other day, is north of $230 billion these days, the options trading-related funds.
It's blown up so much.
Big numbers.
Yep.
And a lot of these funds are promising to investors, hey, we can protect you from a market slide, right? When things like Liberation Day happen, we will fall less than the market. But it seems like they haven't always worked that way.
Well, I consider my job to make it less fun for you because I think some of these things have gone too far. Single day options don't even start me on. Nobody's ever needed that in history. The brokers selling those are laughing all the way to the bank. But buffer funds, we've written a few different pieces on this. I'm going to talk in generalities. Every single one is designed a little differently.
Sure.
Everyone says we're going to do it this way. But broadly speaking, you can think of them as getting a basic stock market exposure like S&P 500 and then trying to what the geeks would call shape the distribution, in particular to modify some of the more extreme events. I'm not going to torture anyone with all the details, but the most common is probably buying 4 different kinds of options, puts and calls, in and out of the money. But at its most simple, imagine you just bought S&P and a put. So you just cut off the downside. You would lose a little upside because if markets went up, you lose the premium you paid. But at some point, if markets fell, the put would kick in.
Right, because puts basically say, hey, we will give you the right to sell stocks at a specific price by a stated date. They're supposed to be like stock insurance.
So if the price is much lower than that, you make money because you can still sell it at the higher price. They're a way to bet on a big downturn, to insure against a big downturn. But even before we looked empirically, we, in theory, were, I admit, a little cynical going in because there are multiple reasons to expect that buying a whole bunch of options to protect a stock portfolio might not be a great idea. You start off with the most basic. You get paid an equity risk premium to be in stocks because they have some downside.
Sure.
Meaning that they return more than bonds or cash and things like that.
Yes, on average, they return more than bonds, more than cash. Not all the time, of course. And that's somewhat the point. Sometimes you have to suffer. You have to always be a little immediately cynical when someone says you can have most of that without the scary part, because the scary part is probably why you get paid. It's probably why, there is an equity risk premium.
It's the price you pay for the stock market returns, right?
Yes, well put. I'm going to say it that way from now on. And I think it's pretty intuitive that in a well-functioning market, if it were break even, everyone would want this. You'd say, hey, do I want to make money in the extremes, a little extra? If on average it comes out, I think most people, it's like getting free insurance. Another way to get a lot of the upside of stocks but limit some of the downside is rather trivial. Combine it with some cash. If you have 80% in the stock market and 20% in cash, this will be the only math in our podcast. You get 80% of the upside, but 20% of the downside is reduced.
And by the way, that's how Grandma and Grandpa told you to invest, right? Like put a little in stocks and a little in bonds and
basically there'll always be exceptions when you're looking at lots of funds. but the vast majority of buffered funds, when compared to a very simple, straight-up mix of an index fund and cash, didn't outperform it. They underperformed it and didn't have smaller drawdowns. They had larger drawdowns.
So another flavor of these funds is the equity hedged funds. And I do think this is kind of a disaster. I believe you guys looked at a slice of equity hedged funds with at least 5 years of performance and found that the majority failed to deliver either better returns or less severe drawdowns than a portfolio of cash and stocks. That is not a great showing.
I have very little to add to your comment. You nailed it. There was I forget the numbers. There were probably a couple that did well. If you test 100 things, and 90 are bad, are the 10 that are good really good, or is it just something's going to get lucky?
Yeah.
But by and large, it's a bad bet to go down this route. If I were giving advice to someone in my family who was nervous about the stock market or thought they had too much, either strategically or tactically, I say sell some stocks. Real simple.
Yeah.
Don't get this. This is too cute by half is another way to put it. The really scary scenario for an equity investor is not a short, sharp crash that largely reverses. It's a grinding bear market. It's in the extreme, it's the GFC. In less extreme, it's 2022.
GFC being 2008, 2009.
Yeah.
That crash.
Exactly.
Yeah.
The global financial crisis. A grinding, slow, but never crashing bear market. That's, I think, the worst scenario for an option-based strategy. Because options, to the extent that the strategy would ever excel, it excels in really big moves because options start to do better as the extremes get bigger. A grinding bear market, you never get that extreme move, and options premiums tend to go up and up and up because in bear markets, insurance becomes more expensive. We think not only has the record not been particularly good, but there are scenarios out there where stocks plus cash would dominate it by even more. So I won't mince words. We recommend against buffered funds.
And is that partly because, the way I think most of us are taught to invest is some version of dollar cost averaging, right? Which is like if you just invest a little bit all the time over the course of many years, you pay more for stocks during those big bubbly markets, and then you pay less for them during those grinding bear markets, and they sort of balance themselves out, right? When should an investor think about doing something different? When does it make sense to just deviate from that and look for a product that either offers some form of insurance or some uncorrelated return? Like when does it make sense to deviate?
Oh, well, now the second one is something I sell.
Right.
So I feel very differently about that.
Okay.
That won't be too self-serving, I'm sure.
I mean, we asked you on
more.
the podcast,
Yeah.
so here we are.
When to hedge, really, it's kind of a smart-sounding way to say when to time the market.
Right.
Right?
That is such a good point.
Because a hedge is, if you have a hedge on all the time, you're not timing the market, you're building a buffered product. But if you're doing it sporadically, you're timing the market. And, I have great cynicism that the average investor should be trying to time the market. There'll always be someone who gets it right. In some cases,
and they'll brag about it, like
Yeah,
on Reddit,
yeah.
and
And
entice
the
everybody
world's
else to
very
do
good
it,
at ex
right?
post
Yeah.
finding the few people who got it right and telling you that they're the next geniuses. I think I've been on the good and the bad side of this PR over time. It's one's more fun than the other, but both are silly. So I don't think for the average investor there's really ever a time I would say time the market, and certainly not to hedge the short term. I do believe that very long-term returns, kind of 10-year returns, are higher when markets are cheap versus history and lower when markets are more expensive versus history. Doesn't always work. Even over 10 years, it can be wrong. And even there, you don't seem to add a lot of value. Very often, if markets are expensive, the rational prediction is they'll make kind of half of what they normally make. I will now, in a very different sense of the word, hedge a little bit. We do believe in trend following strategies. Those do take market positions, and you could call that a form of market timing. But they're based on an actual empirical relationship that when this happens, this usually happens. I think the average investor out there, when they're nervous they might actually be wanting to do the opposite of what they're feeling. But if they just do nothing, I'll be happy. I think that's pretty good. That's a win.
I mean,
That's
I'm
good
pretty good at
advice.
doing nothing. That's sometimes my,
Doing
my favorite
nothing
thing to do.
can be extremely hard. Doing nothing
Because the temptation
when
is
stuff's
such to,
going
like,
on
react,
and people are
right?
telling
Yeah,
you, you're getting all kinds of advice in scary times. And I would say even for professional investors, doing nothing is surprisingly often the right strategy. Like for someone like us, it's like if there's a tough period, you want to make a change to your process.
Yeah.
Every once in a while, you discover, hey, we learned something. Maybe we should tweak. I think most of the time anyone ever does that, they're almost perfectly wired to make an error. And sticking with what we do, sticking with our process has occasionally been hard, but I think we've been successful at it. And we've come out the other side making well more back than we ever lost in those events. And had we caved in the wrong direction, it would have been very bad. So doing nothing in this case is white-knuckled terror for about a year. So you don't feel like you're doing nothing, but you're not doing anything reactive and stupid in the portfolio.
Circling back to what we started to talk about before, which is we've been talking about the dangers of hedging, of trying to like insure yourself against outcomes. Yeah. But your business is about finding uncorrelated returns. So what's the value for someone thinking that, well, if I just stick with S&P 500, I'm doing great? What's the value of thinking now about those uncorrelated, even if hedging is not the right thing to do, why is looking for something uncorrelated a good kind of anytime strategy?
First, I'm going to just hypothesize a good alternative.
Okay.
We often strive for true zero correlation, but it doesn't have to be.
Correlation, just briefly, like when something goes up, this thing goes down or doesn't go up. Things that don't.
I would say uncorrelated means if you tell me this thing is up or down, it's no information about this other one. Negatively correlated is a hedge. Negatively correlated is it moves the opposite. But imagine you found something. And for us, it might look like long 1,500 stocks in the world, around the world, short 1,500 stocks in a balanced way. So if you do that well, you're not particularly correlated to the market. And if you do that well, and I'm just assuming we're doing this well at this point, your longs on average, not all the time, but on average, substantially beat your shorts. That is always valuable to a portfolio. To be able to add an uncorrelated return, the math just says, yeah, you would do that. If the stock market is so insanely great that any dollar taken out of that, even if the uncorrelated return makes 10% a year, if you took it out of the stock market making 5% a year, there is a pretty decent chance you've lowered your total return but reduced your volatility. And this gets to your comment before, which I've said before, that you've improved your risk-adjusted returns, but you can't eat risk-adjusted returns. There are simple ways around that. If you, for instance, just equitize the alternative, meaning take some money out of stocks, put it in an alternative, but that alternative you really think of as the uncorrelated long-short fund, but then you add an S&P future on top. You're not doing that because you tactically want that in the alternative. You're doing that just to replace what you took it out of. Then you are simply adding. And then if the uncorrelated alternative goes up, it's just gravy. The numerator goes up. Yeah. So I think there are lots of ways to design this to fix it. But I do think, on average, we've been in a pretty unique environment. U.S. large cap equities, they've crushed bonds. They've crushed equities around the world.
Not Pokemon cards, though.
Okay.
Cards.
There are some exceptions, though I think the capacity for us all to invest in Pokemon cards is probably limited. When that happens, it drives me crazy when people say diversification didn't work. I get really geeky and I go, oh, sure it did. It just worked for different people. You have a U.S. large cap perspective. Anyone not from the U.S., for instance, found diversification work like a charm. Diversification always works. It just doesn't always work for everyone at the same time. So if you're in a unique environment, and again, if 15 years ago anyone told us the U.S. would crush the world, and by the way, a lot of that has come from what's called multiple expansion. The U.S. has outgrown the world, so some of the performance you can call organic, real stuff that you don't have to ever give back. But a lot of it has come from the U.S. going from cheaper than the world, at least 25 years ago it was cheaper, I don't know about 15 years, to more expensive than the world now. And that's a great way to outperform. It's just revaluation. But expecting that to happen again from instead of starting cheaper, from starting more expensive, seems very naive. So for a pure U.S. large cap investor, there were ways to do it smart. Again, equitization where diversifying still would have helped the top line. But it was a tough time in general because it beat everything. If you didn't get cute with that stuff, you probably diversified into something that maybe improved your risk adjusted, but not your total return. I think people looking at that are fighting the last war. I think the U.S. is great. I'm a believer in a lot of U.S. exceptionalism, but at substantially more expensive than the entire world. Do I think it's going to radically outperform? Even if it doesn't regress to the mean, even if you don't forecast those valuations come back down, all they have to do is not expand again, and you want diversification again because it won't crush the world by the same amount. So I think diversification's frankly always something I'd recommend, but I feel better about it now for a U.S. investor than normal.
We'll be back with more with Cliff Asness, the Chief Investment Officer at AQR Capital Management. Cliff, I really want to take a little bit of time to talk about efficient markets. I think we've spent quite some time talking about how much markets have changed the past few years, right? And you've written about how with social media, derivatives trading, one-day options, technology changes, you think markets have gotten less efficient. Tell us why.
Yeah, and I should start out saying this feels a little heretical for me.
Because you're a Chicago school guy, right?
And a guy named Gene Fama, who is the godfather of the efficient markets hypothesis, Nobel Prize winner. But I probably think the market is less efficient than he does. And I've moved on that in the last, call it 25, 30 years. To be fair to Gene tells his class, which I took 3 times. I didn't fail it. I was the TA for the next 2 years.
Okay.
About somewhere around the 3rd week, he tells the class they're almost assuredly not perfect. Perfection is a fairly insane hypothesis. So right there, it's like some bad old jokes. All right, we've already established it, and now we're just bargaining.
You talk about why you think markets have gotten less efficient.
Yeah. Because it feels contrarian to me to say that because we know that people look at satellite pictures of parking lots so they know what the foot traffic of a store is going to be before it reports earnings.
Yeah. Short-term getting information into stocks, I think markets probably have gotten more efficient for the reasons you cite. So I don't deny that technology and the speed of trading and whatnot has made markets, in that sense, more timely, if you want to use efficiency in that way. And what we were talking about before, a valuation trade where are these 1,000 stocks reasonably priced against these 1,000 stocks when you sort them? Technology has very little to do with that. How fast you trade, how cheap you trade. This is about behavioral biases. This is about market structure changes. And my 2 favorite hypotheses, and I have to admit they're hypotheses. The weaker one, I think, but one I still like, is one you've heard a million times, the rise of passive investing. I am not a fanatic about this. There are people who think passive investing is the devil and is destroying the world. But I absolutely acknowledge something that many people have looked at. It's kind of obvious. We can't all be passive investors. So I find it pretty easy to believe that more people doing passive, fewer looking at stocks and actually trying to evaluate their prospects could loosen the bounds of rationality and make us deviate bigger and more. That's actually my second favorite hypothesis. My first, and here I know I sound like an old man on his lawn yelling at clouds. I'm Abe Simpson here. Social media, 24/7 online, gamified trading, the whole ecosystem of all these things. It started out in the dot-com bubble with what it would call message boards, which again would probably be before your time, but this was like proto-social media, but it was a big part of that bubble, which it's funny because it makes me think, hey, I might be onto something here. And here, I'll get a little dark here because I start with our politics. And I'm not going to make a politically partisan statement. I'm going to make a statement I think most people, not everyone, would agree with. That the social media environment has probably made our politics worse, has probably polarized us more, put us more into our own bubbles where we only see self-reinforcing things, has enforced a mob, has encouraged a mob mentality. Well, one thing about stocks is stocks are priced by a voting mechanism. It's not an arbitrage mechanism. It's never an arbitrage to short a overly expensive or buy a cheap stock. It's a bet. It could work out against you. The cheapest stock in the world could deteriorate so much that it was a bad buy. Famous falling knives, the most expensive stock in the world, could turn out to actually be the next NVIDIA. And it turned out that paying a 2,000 PE for that was actually not such a bad idea. So it's not riskless. You vote. The more votes that go one way, the higher the stock price goes. But if this environment has poisoned our voting mechanisms in politics, why would it not affect our markets? And it's cheating to look at the most extreme example that makes your case. And I'm about to cheat. Take the meme stocks,
they're back this year.
Yeah.
They are.
They
They're
are.
back this year.
They are. It's not quite as nuts as it was, and they're different stocks. But the meme stocks are a completely online mob phenomenon. Doesn't mean one of them won't work out. Again, I do think the meme stocks are unfair in the sense that, there are a lot of, I wouldn't call NVIDIA a meme stock. They make a ton of money. They may be worth what they are.
But I would
today.
say I would call Palantir, Tesla meme stocks. I think the meme stocks have evolved past this tiny group of unprofitable companies.
They're further on the spectrum to meme stocks. These are stocks that have a very meme-like component where they're a little cultish. So I net agree with you. Again, I'm using the most extreme example, but you did a wonderful thing. I was about to say the rest of the market is a point on a spectrum. Palantir makes money. Tesla makes money. You can't call them that. But are they on the spectrum to that, where they're a little cultish and driven by a mob of people who feel so strongly and will shout you down and call you terrible names if you disagree? Yeah. So I do think these things have made markets maybe not on average every day more inefficient, but maybe more susceptible to bouts of extreme inefficiency where the world just goes somewhat mad.
I want to drill down on that because I've followed, I think, one-day options, right? Trades that expire within minutes or hours. They have been one of the hottest crazes in markets of the past few years. Why don't you think they're a good idea?
I think if you back out what you're paying for those options in terms of, the implied volatility, what's a likely outcome where it gets paid, I just think they're going to be very bad deals. They're very, their popularity can be summed up with FanDuel's is very popular too. And I promise you, the average player on FanDuel's loses because FanDuel's makes money. It's pretty easy to figure out. And I don't think single-day options are really any different. I think the people who sell them are doing pretty well. And I think the people who buy them, like all gambling, there are fabulous success cases, right? And everyone posts there, I bought, it was one-day thing and it went through the roof. We don't deal with that. We deal with averages when we're giving advice. If you assume you're the best in the world at something, more power to you. You'll probably do well.
Yeah.
But if you assume you're average, these are bad ideas. You're paying too much. You're making Wall Street, some version of Wall Street rich and yourself poorer.
So all these trends, right, the gamblification of traditional financial markets, I think they're set to grow more extreme. You can literally place sports bets on Robinhood right now.
They're merging, right? You can do your stock, crypto, and sports bets all in the same place.
What does that mean for financial markets? Does that mean these moves might get more extreme?
They might. Markets equilibrate. Geeky for return to some form of rational on their own. It's just a question of how long and how painful it takes. The old Warren Buffett, in the short run, the market's a voting machine. In the long run, it's a weighing machine. What he's saying is, what I said that it's a political process and it's voting is right about prices today, but ultimately truth wins. Do not ask me to tell you when. We don't try to trade when. We include both valuation, quality, and momentum in our models, so we're trying to have the best of all worlds. So we're not trying to time this to the second. But for all the kind of scary things I've said, I will say, particularly with new technologies, I think there's often a curve where the world goes a little nuts with them for a while and eventually learns how to deal with them more rationally. The question is, how much damage is done between now and my predicted return to the promised land of a more rational, never perfectly rational market.
I don't see brokerages or Wall Street pulling back on
Oh,
these
they're
trades.
never going to
These are
pull back.
technology changes that have occurred, and you can't undo them at this point.
Hopefully someone will ever trade with me again when I say bad things about Wall Street. Wall Street's job is to sell you. They're like a car lot. They're there to sell you new and used stocks. They sometimes package them into very interesting things, but they will sell these as long as there are buyers. There's never going to be the case where Wall Street's going to go, we've been really successful selling these for the last 5 years. We made a ton of money. But frankly, the investors are having subpar performance, so we're going to pull back. I wish we were in that world. I do believe, I'm going to brag, that if AQR had a product where we were finally convinced, we wouldn't do it if it wouldn't take us a lot to convince us it wasn't good. We would never have started it to begin with. But ultimately, if we think, we're just not good at this, I think we'd stop. I don't think Wall Street is wired for that. So it has to come from disappointed investors who slowly, people said the same thing about every bubble. The dot-com bubble, people could not see how it could ever end. It kept going up. It kept going up. People were like, it's the future. And then we got to a point where people were burning through cash in these companies. Because a lot of new companies need a ton of cash to get going. We could see something like that happen again, where eventually you just run out of money. So I don't know the precise form. I do know it won't come from the street charitably saying, no, we're going to stop this. It's not good for you. It's like a restaurant saying we're going to only serve you really lousy tasting healthy food. Unless you're explicitly a health restaurant, most restaurants would go out of business doing that. And I don't think the street's going to do that. And I'm being cynical about them. I don't think it's necessarily their job. They're brokers. They're not investment advisors. They're not telling you everything they're offering you is great. They're saying, here's the bet. If you want to take the bet, take the bet. I am simply advising people they probably shouldn't be taking that bet. So I don't even want to be as critical as I'm sounding. All I can tell you is the deeply unsatisfying, this will end, or at least will abate.
I don't know if people in the audience should take away the idea, though, from this, that you're saying that people should run away from risk. Right?
No.
Or volatility. In fact, you wrote you've been critical of vehicles that kind of mask volatility from people when people try and think they're hiding from it. And you wrote recently, you said, I'm advocating for it, lean into volatility is the motto of that particular piece you were writing. So why should investors embrace volatility, but how do they avoid some of the pitfalls you've been talking about here?
The way most of the world makes their money is markets going up over time. So if there's still a positive premium, the more vol you take in that, the more you will make long term. If you take too much that you can't take it, that you have to get out at a low, you've taken too much. Yeah. But volatility, it's the price of admission. It's what you accept to get the upside. So I'm certainly not anti-volatility. What I wrote recently was about alts in particular, uncorrelated alternatives. One criticism, and we were talking around this a little before, one criticism of alts, which has some bite to it, is they can improve the risk-adjusted return, but not the top line. I suggested then equitizing them, which also works. Another thing you can do is be more aggressive in your alt. If you do double the alt, you'll have double the swings. You have to be able to tolerate that. But you can get it probably to a point where it does move both the top line and possibly reduce the bottom line. And, as long as an investor does that with open eyes and knows what they're doing, I think that's a tool to be able to take more volatility.
We're going to take one last break, and then we have a final question for Cliff. President Trump has advocated for getting rid of the requirement to report quarterly earnings and proposed moving to a 6-month model instead. What do you think of his proposal?
This is a hard one because my instinctive reaction is not to like it because it feels a little like what we've been talking about with volatility laundering. Things will look less less crazy. There's great uncertainty about whether this would make things calmer or less calm, because people think quarterly stuff makes things less calm, but the stakes are raised if it's every 6 months. Suddenly that number that on a quarter can drive things, you're going to learn a lot of new information. Though I have to try to be intellectually honest. There's no magic to a quarter. We made that up in the past. If you told me the right number is monthly and we should make this a more perfunctory thing that no one gets too razzed about, or you can make it annual, again, there's no proof. I personally prefer more information to less, so I don't love it. I think the motivation on it is to get closer to the private world, just like there's a move to put privates in 401ks. There's a movement to show less crazy, just to damp it all. And I don't like that because I like closer to truth. But this is not the hill I'll die on, because I have no theoretical world that says quarterly was right and everything else is wrong. I do think the general knock of short-termism, which is part of the argument against quarterly, I think that's overdone. Like the most expensive stocks in the world today are not short-termism. They're because people think they're going to do this over the next 10 years.
We often talk about how their quarterly reports don't even seem to matter to the trajectory of the stock, right?
So I think short-termism is generally overdone. I still think the stock market is mostly focused on long-term. It'll react to short-term information, but it's part of a discounting process of what they think the next 30 years will look like. So I can't get my back too up on it. I probably wouldn't change it, but of the many things out there that if I were the demigod in charge of markets and got to set the rules, this would not be high on my list. I'd be okay with it.
And lastly, what do you think is the biggest risk to markets right now?
I don't know. I'm not a monetary economist, but I think the Fed has at least a mild bind right now. Economy on some things, I think there's definitely at least a little slowing. I'm not a doom and gloomer. I won't say it's we're about to fall off a cliff, but we see a little slowing, and inflation is still at the high end of the range they want. My personal guess is they cut a little bit next time. We don't trade on this. We're not Fed watchers. I could be totally wrong about this and we could do very well, or I could be totally right and we could have a lousy period. This is not how we make our money. So this is purely me. But I don't think they can do very much when inflation's still at the high end of their range. So that's a little scary. My biggest worry is probably, some of the things we've been talking about. There is a lot of froth. There is, the thing you and I talked about how this ends. It will end, but how it ends. And the old Robert Frost, some things end in fire and some things end in ice. Financial things could be the same. Some things end with long, slow, lower returns than you expected. Some things end in a conflagration. And no one knows how to forecast that. So when we have the world that we've been talking about this whole time of mob psychology and bigger moves, maybe you have a slow air out of the balloon, but maybe not. And I'm not making big bets on this myself, but I do find it a little frightening.
Right. What's happening in the political world is echoing what's going on in the financial world.
So far, if anything, I've been shocked how little, aside from Liberation Day and the aftermath, on how little some of the volatile politics around the world has affected markets. I actually think most of that is actually fairly rational. I think politics actually matter less to company earnings, which is ultimately what's going on, than sometimes people think. But historically, they do react to it. So maybe I could view this as a positive, that in this sense, maybe they're getting more rational. But it also feels a little weird that they're acting different on that front. It feels a little like they're just whistling past stuff.
Cliff, this has been so fun. Thank you for joining us.
Thanks for being
thank
on.
you. I really enjoyed it.
Yeah, this is great. Well, actually, it's funny. A few weeks ago, we were prepping for a podcast episode, and Telis was like, "Did you see Cliff's tweet on Fartcoin?"
That was a while ago.
Kicked off a whole
Maybe it was more than a few weeks ago.
I've had some fun.
Thank you.
The
for
very
that.
fact that the world is so weird that they have people like me discussing something called Fartcoin.
Yeah.
They've achieved something.
It's a legitimate, financial, right? Like it's worthy of coverage in the Wall Street
And the
Journal.
bad jokes just write themselves.
You can just fart them out.
Yeah.
Okay.
as they say.
Okay. Moving on.
Yes.